Are you a high-income homeowner in Silicon Valley feeling the pinch of high taxes? If so, you're in the right place. Today, we're diving into a crucial update that could significantly impact your federal tax burden: the potential increase of the SALT deduction limit up to $40,000. For more detailed information on SALT deduction, please refer to our blog post, display link. First, let's establish a foundational understanding of the SALT deduction. SALT stands for state and local tax. It allows taxpayers to deduct state and local income taxes, property taxes, and sales taxes from their federal taxable income. For years, the $10,000 cap on the SALT deduction has been a major source of frustration, particularly for high-income earners and homeowners in high-tax states like California. Silicon Valley, a hub of innovation, also ranks among the regions with the highest tax burdens in the United States, amplifying this frustration. Prior to the 2017 Tax Cuts and Jobs Act, or TCJA, there was no cap on the SALT deduction. This meant taxpayers could deduct the full amount of state and local taxes paid. However, the TCJA introduced a $10,000 limit, a change that significantly impacted many taxpayers. This $10,000 cap meant that if you paid more than $10,000 in state and local taxes, you could only deduct a fraction of that amount. For high-income earners in high-tax states, this effectively meant paying tens of thousands of dollars in undeductible taxes, leading to a higher federal tax burden. Let's consider why the SALT deduction is especially crucial for high-income earners in Silicon Valley. This region is known for its high property values and corresponding high property taxes, as well as significant state income taxes due to high earning capacities. Take a typical Silicon Valley resident as an example. Their home value might be approximately $2 million, leading to property taxes around $20,000 to $25,000 annually. With a W-2 income of $600,000 or more, their California income tax could easily exceed $30,000. In total, these residents often pay over $50,000 to $60,000 annually in state and local taxes. However, under the previous rules, they could only deduct up to $10,000. This disparity directly led to thousands of dollars in additional federal tax burden. Now, for the big news. The Senate recently made a surprise announcement that could change everything for Silicon Valley taxpayers. A bill to raise the SALT deduction limit has passed the Senate. On July 1, 2025, a bill to raise the SALT deduction limit to $40,000 for 5 years, from 2025 to 2029, was passed in the Senate by a vote of 51 to 49. This is a significant shift in tax policy. Let's look at the key details of this new cap. It's applicable for the period of 2025 through 2029. The previous limit was $10,000, so the new cap is 4 times higher at $40,000. This is a substantial increase that offers considerable relief. For households with incomes over $500,000, the deduction will be phased out gradually, but it will not go below $10,000. It's also important to note that after 2029, the deduction is expected to revert to the original $10,000 limit from 2030 onwards. Additionally, the PTET, or Pass-Through Entity Tax Workaround, is still maintained separately. So what does this actually mean for Silicon Valley taxpayers? Now, even if you pay $50,000 to $60,000 annually in state and local taxes, you can deduct up to $40,000 of that amount. This directly translates into significant federal tax savings. Let's break down how this increased deduction leads to substantial federal tax savings. Previously, you could only deduct $10,000. Now you can deduct up to $40,000, which is an additional deduction of $30,000. Consider this example. If your federal tax rate is 35%, that additional $30,000 deduction can lead to approximately $10,500 in federal tax savings. This means annual tax savings of thousands of dollars directly back into your pocket. A key question on everyone's mind is whether this is a temporary change or a signal for permanent reform. The current bill is structured as a temporary measure. As mentioned, it's applicable only from 2025 to 2029. It's designed to automatically revert to the $10,000 limit from 2030, making this intervention appear as a temporary fix to current economic pressures or political considerations. However, tax professionals are closely monitoring this movement. It could potentially catalyze broader discussions for permanent reform in the future, given the ongoing debate about tax fairness and state fiscal autonomy. This temporary change might just be the beginning of a larger conversation. In closing, what should you, as a Silicon Valley taxpayer, prepare for now? This SALT deduction limit increase bill is a significant change that could bring substantial federal tax benefits to high-income earners residing in high-tax states like California, New York, and New Jersey. While House passage and the final presidential signature are still pending, the current likelihood of this bill becoming law is high. Therefore, it is advisable to start preparing now by estimating your expected state and local tax payments, checking your PTET eligibility, and analyzing your income structure. Remember, tax strategies are always individual and complex. It is crucial to always consult with a qualified tax advisor or certified public accountant, CPA, to ensure you're making the most informed decisions tailored to your specific financial situation. Don't leave your tax planning to chance.